how bad would they let liquidity get before they were forced to intervene? Those types of things can all determine what Bitcoin does in any sort of given quarter or couple quarters. But long term, next 2 years and longer, I'm quite bullish. Bank said, well, okay, we're going to block all banks from sending money to crypto exchanges to try to slow this down, and we're going to introduce a CBDC, and that the government can monitor every transaction that happens, freeze any transaction they don't like. That's kind of the end state from the centralization perspective. But on the other hand, we have, for the first time in history, we have ways to do distributed settlement, ledgers that are backed up by energy in a decentralized manner rather than just tied to like one central bank's ledger.
In a recent economic and market analysis, macroeconomist Lyn Alden shed light on the evolving dynamics of the long-duration Treasury market, pointing out the significant shift towards positive real interest rates amidst soaring debt-to-GDP ratios and substantial fiscal deficits in the United States. This change, according to Alden, signals a return to a more traditional financial environment, yet it brings to the fore the daunting challenge of managing the increased interest expenses on the nation's hefty debt burden. Despite looming recession concerns, Alden maintains a bullish stance on the commodities sector, attributing the momentum to prolonged periods of underinvestment and notable supply constraints, particularly highlighting energy, silver, and gold as prudent hedges against inflation and economic turbulence. Furthermore, Alden delves into the evolution and potential future trajectories of global financial systems, drawing historical parallels and emphasizing the possibility of a shift towards a revaluation of gold by central banks. Now, we'll show you more clips of Alden, but first, subscribe, and turn on notifications, and check our pinned comment for some massive sign-up bonuses. Enjoy the video.
Is that this was largely a technological phenomenon. So ever since, if you go back to kind of the full history of banking, mostly what you're trying to do is make money more efficient. So gold is costly to move around, it's costly to verify, it's slow. And so most of the history of banking was, how can we move this faster by moving it as little as possible? So for example, you deposit gold in a third party, and then if me and you are both using the same party and I want to send money to you or you want to send money to me, we just contact that third party and say, debit from this account, add to this account, and that just represents our claims of that gold moving, and that trusted third party just keeps holding the gold. That way the gold has to move and get verified less often. That's kind of the multi-century history of banking. For the most part. And whenever that kind of blows up, you add another layer of centralization. You kind of just built centralization on top of centralization on top of centralization. And what really kind of kicked into high gear was the introduction of the telegraph. And so that was invented in the 1830s, but it wasn't really widely deployed. I've been trying to stick to like a 2-year view because I don't really know for sure what's going to happen in 2024. I have higher conviction that throughout the course of 2024 and 2025, it'll be notably higher than it is now. That's kind of my overall base case. I'd be surprised if we didn't see 6 figures in that 2-year view. Certainly possible that we won't, but I'd be surprised if we would not. And from there, there's a very big range because you're basically you'd be trying to predict what do humans do when the price goes up. Well, how much of them will buy, I don't know. But basically, we know the supply side. We can also look at on-chain indicators to see, for example, the behaviors on the supply side. So you can look at how many coins are held by entities that have a very low propensity to sell. And during bear markets, that ratio goes up. The people that have been buying coins in the bear market, that have gone through a lot of that, they're generally not going to sell anytime soon, even with a significant bull run. It would take a very high price point to get those coins out of their hands. On the other hand, when you have bull markets, you have a lot of new buyers coming in. Generally, that's the handful of times when those longer term holders tend to sell. They sell into that strength. We've not really seen that cycle start yet. And so I still think we're fairly early phase in the bull market. But that doesn't mean anything about 3 months or 6 months. Generally, my research shows that Bitcoin price is heavily correlated with liquidity in any given multi-month period, generally speaking. And so kind of the stuff we talked about earlier in the conversation. What happens when the reverse repo facility gets low? What are some of the liquidity actions that they can resort to? How bad would they let liquidity get before they were forced to intervene? Those types of things can all determine what Bitcoin does in any sort of given quarter or a couple quarters. But long term, next 2 years and longer, I'm quite bullish.
Lyn Alden shared her thoughts on how money has evolved from gold to digital currencies like Bitcoin. She explained that while gold was secure, it was also heavy and slow to use, leading people to develop paper and then digital money to make transactions faster. However, these new forms of money often lose value over time. Bitcoin, according to Alden, stands out because it's digital but also secure and not controlled by any one government, making it a promising solution for fast global transactions without the traditional banking system's limitations. Now we'll show you more clips from Alden, but first, subscribe and turn on notifications, and check our Bybit partnership promo where you can start trading real crypto for free. Enjoy the video.
That the government can monitor every transaction that happens, freeze any transaction they don't like. That's kind of the end state from the centralization perspective. But on the other hand, we have, for the first time in history, we have ways to do distributed settlement, ledgers that are backed up by energy in a decentralized manner rather than just tied to one central bank's ledger. And so we kind of, for the first time, have the ability to do speed without centralization. Whereas for centuries, almost every friction in money is solved by centralization. You say, okay, we'll just make this friction go away by centralizing it. We'll just use the shared ledger. And then when that has frictions between another shared ledger, we say, okay, we'll build a bigger ledger under them. We'll make it a central bank. And when central banks have trouble, kind of connecting with each other, they resort to connecting it into an even bigger central bank. So the world reserve currency, it used to be Britain, now it's the United States. Almost every problem is solved by centralization. But with this technology, as long as humanity has the internet and other high bandwidth manners of communication, which they've had for a long time now, there's ways to do this in a more distributed manner. And so I think that technology is going to be very powerful. And we've kind of seen interesting scenarios where, for example, in Nigeria, they have ongoing long-term currency crisis, high inflation, persistently high inflation, and so they had, they also have a fairly tech-savvy population, especially in cities there. And so you had very high adoption of things like Bitcoin and stablecoins. And so the central bank said, well, okay, we're going to block all banks from sending money to crypto exchanges to try to slow this down. And we're going to introduce a CBDC. And what happened was that ban was in place for something like 3 years. Nigeria, by most metrics, for example, Chain Analysis estimated that they had the second highest crypto adoption in the world, and specifically the highest peer-to-peer trading volumes in the world, because that's how they went around those bank blockages. So they failed to slow down Bitcoin, stablecoin, and sometimes other crypto use cases or speculation. At the same time, their CBDC had very low and slow adoption. No one really wanted it. It wasn't really solving a problem that people wanted. And in recent months, the central bank has actually reversed their prior ban. It's kind of acknowledging that it was not working, and instead they're saying, well, let's instead try to regulate this because it's not working. And I think that's kind of a theme we're going to see a while, is that, central bank digital currencies, they don't really solve a lot of problems that people are looking to solve. And so I think we're probably going to see an ongoing battle between what policymakers want to happen and what the people find actually kind of serves their needs better. Not that much, because, so for example, Bitcoin has a difficulty adjustment associated with it. So for example, if energy costs spike and the price of Bitcoin does not, then the weakest miners go bankrupt or stop mining. And then the network checks every 2 weeks, what is the average rate of block production, which depends on how many miners are on the network. And then if miners have fallen off the network, then it makes block production easier. It basically calibrates to the number of miners that are currently on. And so energy, it's in and of itself, does not really directly impact miners. The indirect thing is that governments can use that as a narrative, because governments don't particularly like the fact that things like Bitcoin exist. And so if you get energy price spikes, then you get things like, governments blaming Bitcoin for it, or trying to say we have to push Bitcoin out of our jurisdiction. And so it really can kind of move around where the Bitcoin miners are, or to determine kind of how difficult it is to operate a mining business. But for the most part, it doesn't really affect the blockchains themselves, because that's been taken into account by the design. In fact, that's arguably Satoshi's main addition, because when you put Bitcoin together, there are a bunch of things that already existed. He didn't invent blockchains. He did not invent proof of work. He didn't invent the types of encryptions that he used, but he put it all together, and then he added the automatic difficulty adjustment, which is kind of the control mechanism, the automatic control mechanism that makes it work. Because if you tie money creation to processing power, then as processing power increases exponentially, it would eventually inflate the currency. It would result in quicker block time generation than expected, and therefore more coin issuance than expected. And so having that difficulty adjustment in there makes it so that even as processing power keeps increasing, it does not result in faster block times. And even as you get, say, higher or lower energy prices, the network adjusts for that.
What do you think of today's episode? Is Lyn Alden correct saying that fiat money is broken? Will Bitcoin outperform gold and silver over the next decade? Post your answer in the comments section. Share this video with a gold bug and watch this video because you'll love it. I see you on the other side.